So we're going to do a deep dive into this adjustable rate mortgages and this ARMs that has been making a strong comeback in a few weeks. So I want to make sure everyone feels comfortable and completely confident explaining them, structuring them, and knowing when to recommend. So these are the things that I'm going to cover today. We're going to start with ARMs, the basic structure and the terminology. Then we'll look into how the rate actually adjusts. And after that, we'll walk through how to qualify a borrower using the ARM product. And finally, we'll walk and talk about the trade-offs, ARM versus fixed. And by the end, you'll be able to run this analysis with different and any clients. So what exactly is an ARM? Simply put, it's a mortgage where the rate is fixed for an initial period and then adjusts periodically after that, either up or down based on the market condition. There are two main families within the ARMs. First is the SOFR ARMs. Whenever you see 76, 36, 56, anything that ends with /6, meaning that they adjust every 6 months after fixed period ends. Second, CMT ARMs, anything that ends with 1, which adjusts annually, is using the base rate of CMT. The first number always shows how long the rate is fixed, and the second is how often the adjustment after that. Simple, very simple as that. So this is the core formula that you need to memorize. When you explain what the rate is just deformed, the new rate is equal to index rate plus margin rate, subject to caps. So let's break each piece down. The index is the market benchmark, either the SOFR or the CMT rate we use. It moves with the market. Your borrower has zero control over it. But the margin is the lender's fixed spread. Our yield spread also depends on this. So typically, somewhere between 2 to 3%, this is the set origination and never changes for the life of the loan. Caps, the third number that we see when we talk about the adjustable rate mortgage, is a guardrail. There are 3. The initial cap that limits how much the rate can jump at very first adjustment. And the second is a periodic cap, limits each subsequent adjustment. And the lifetime cap, the third, is the absolute maximum the rate can ever go above the starting rate over the life of the loan. So think of it like a speedometer. The market can push the rate, but the caps put a ceiling on how fast it moves. So when you see these 3 different options, you get to find out which indicators that we are using so that we can introduce the client what the initial, periodic, and lifetime cap will be. So when a borrower asks, how high can my rate go up? You just need to able to answer them instantly. So this is where a lot of loan officers have a hard time with. So I want you to close attention to this detail. First, you need to know what the FIAR is, this fully indexed accrued rate. Whenever you read the override underwriting guidelines or processing materials, we seldomly talk about this, but you need to know the fundamental idea of what this means. It is just index plus margin rounded nearest to the 0.125%. So when you see the rate, it always moves up to 0.125. If the starting rate is at 6%, it goes up to 6.125, 6.25, and 6.375, and so forth. This is a rate that the loan would be if it fully adjusts today. No initial discounts, it's an actual math that you just input. And second, there is a threshold. So when the fixed period is lesser than 5 years, such as 3.6 or 5.6, you qualify the borrower at the greater of the note rate plus 2. So think of note rate plus 2%. This is more conservative standard. That's why the starting rates are cheaper, lower than the other product. But when the fixed rate is greater than 5 years, such as 7.6 or 10.6, then you just qualify at the note rate. It's a borrower-friendly option. Look at examples on this screen where you talk about the 5.6 ARM. When you see the note rate at 5, add the 2%, so the qualifying rate becomes now at 7%. On the other side, 7.6 ARM, when the note rate is at 5.5, qualification rate is still at 5.5. So you're going to run into this mortgage insurance premium when you are selling this ARM product. So whenever you see MI premium, think of the MI price, same as fixed rate whenever you sell a period that's greater than 5 years. But if it's not, you need to look into both options and shop around. So trade-offs of ARM versus fixed is ARMs win over the lower initial rate and the payment, faster equity buildup, and ability to direct and redirect those savings into elsewhere, investments or strategies. Fixed wins on the payment certainty, simplicity and peace of mind. So whenever we see a client from 2020 through 2022, when the rates were in 2s and 3s, you'll be unfortunately see many clients wrote 3, 7, 10-year fixed rates at 1 to 1.5%. They didn't anticipate this rate decrement to ever last, but they failed miserably. Loan officer indirectly misguided them not to give them a 30-year fix. Therefore, if you look into these, adjustable rate mortgages, that's going up from 1.5 to 6.5 to 7% within a month. So ARM's advantages are real. The payment shock is genuine risk if the rates spike, and the harder product to explain. So our job as a loan officer is not to push one over the other. I mean, you need to present both clearly and let the numbers lead. So when we talk about the $640,000 loan amount, 30-year fixed versus 6.5 at 7.6 ARM at 6%, the payment on the 30-year fixed $4,045.24. The ARM is at $3,837.12. So this monthly saving of $208 for the 7-year mark is about $17,482. So now you give them this Excel chart or payment breakdowns and then tell them reasons why ARM product can be a better option than a fixed rate mortgage option. This one helps the borrowers to make a good decision, better decision. So is the adjustable rate mortgage right for the client? When you review these 6 different questions, this qualification checklist into a conversation, then you can lead into a better outcome. How long do they want to or plan to own the home and sell? If it's shorter, within 3 to 5 years terms, ARM is a strong play. But if the payment certainty matters, if the income type changes, if both of the applicants thinking of relocating their jobs, not working because of family planning and so forth, this risk adverse client almost always want the fixed. So when you look into the income growth, is their income likely to grow? Rising income offsets the future rate risk as well, leading a conversion into refinances. Any major upcoming expenses, tuition, medical, cars, these affect capacity, this debt to income ratio. And what are the rate expectations? As Ragnar mentioned, we are not looking into a crystal ball and expect something to come up. Nobody can predict the rate. Don't let the client bet on the house on a rate outlook. Run through these numbers and the checklist and navigate the right product. That's usually becomes an obvious answer and the choice. So takeaways. Let's land the plane from all these things that we talked about. 5 things that we can walk away today is, number 1, ARM rate equals index plus margin, limited to the cap on every adjustment. That's a formula that you must memorize. Number 2, the 5-year threshold is critical. 5 years or less, memorize note rate plus 2% for the qualifying rate. Anything greater than 5 years, note rate equals the qualifying rate. Number 3, premium for the mortgage insurance are the same for the ARMs with the 5-year fixed plus, no MI penalty applies. Number 4, the adjustable rate mortgage saves money for now, so you must show every client the max rate scenario. Don't think of it as an option. You have to tell them to deliver a better product, better outcome, and then this risk and problems now becomes an opportunity, will lead into more referrals in the future. It's a part of doing this right way. And the fifth takeaway is always run both options side by side and let the numbers tell the story. Our job is to educate the client, not to sell. So this is an example that I wanted to share with all of you. A realtor sent me a screenshot of this, house payment and the property address and gave me an instruction. They gave me 25% down with 30, 50, and 5 on ARM and 7 on ARM. So within this one text, this person was asking for 4 different scenarios. So this is what I hand wrote and then plugged it into Gemini. And then this is what I sent out. With the loan amount, with a sales price at 2.25, so with 25% down, 1, 2, 3, 4 options were given. Now, the next day, this agent created a group chat. Now he's asking me that the sales price has been changed. I misread some of the information, but I want to show you the full context of how I was communicating with the client. So I was telling them the fixed rate and the, upcomings that we need to know as a loan officer and the home buyer. And then this person says, we're waiting for the listing agent to respond. And the client comes back and says, hey, Sales price is 2.2 million now. Can you run these scenarios? And add 0% down and 25% down and 25% down. He's asking me to provide 7 different solutions with 25% down and 0 and 20% and 25% down. That was just mind-blowing. I was first taking it personally, assuming that it's going to take me forever to create this. But I went back to Gemini, copied and pasted the question and my responses, and I'm going to compute these additional features. And these are the numbers that I brought back. Again, these numbers show a 100 basis point on the pricings. Loan Sifter was helping me to navigate. I was handwriting all these numbers, immediately input it into Gemini with screenshots, and then boom. And the reason why I wrote, oh my gosh, is because I was basing on the numbers on 2.25. I should have changed to 2.2 million. Because now he has an idea, we're putting an offer in and waiting for the final response.